Wolfspeed is currently trading at $24.37, a decline of 1.30% on the session. Now, on the surface, that's just another day of disappointing performance for a stock that has been under immense pressure. The easy takeaway is to see the red and assume the narrative of silicon carbide dominance is failing. However, what most retail traders see as a sign of weakness, some of the largest institutional players may be interpreting as a critical accumulation window. While the price action suggests distress, the underlying story is one of a company spending billions to build the foundational infrastructure for the next generation of electric vehicles and power electronics, a high-stakes gamble that the market is currently punishing, but one that could define the next decade of semiconductor technology. The common belief, the one you'll hear repeated in forums and news headlines, is that Wolfspeed is a straightforward, can't-miss investment in the electrification of everything. They are positioned as the premier supplier of the essential silicon carbide materials and devices that promise to make electric vehicles more efficient, charge faster, and go farther. This narrative presents the company as an essential component of the green energy transition, a clear winner in a world moving away from fossil fuels. But the reality, the one being brutally reflected in the stock's chart day after day, is that being a critical enabler does not automatically translate to shareholder prosperity. The path from technological leadership to consistent profitability is proving to be incredibly arduous and expensive. The market isn't rewarding the long-term vision right now. It's penalizing the immense cash burn required to achieve it. Investors are grappling with the harsh truths of massive capital expenditures, the looming threat of intense competition, particularly from rapidly scaling Chinese counterparts, and the cyclical nature of the automotive industry. This creates a significant gap between the popular expectation of a smooth ascent and the stark reality of a company navigating a treacherous operational ramp-up. Many looking at their portfolios on platforms like the Robinhood app or through SoFi Invest are seeing the consistent decline and are understandably losing faith. But the real story is far more complex than just the daily price swings. It's about whether the company can bridge the gap between its current spending and future earnings before the market's patience completely runs out. Looking closely at the recent stock movement, the price action tells a story of persistent bearish sentiment. The stock has been in a prolonged downtrend, breaking through several key support levels that technical analysts thought might hold. Trading volumes on down days have often been significant, suggesting conviction among sellers. This isn't the gentle, low-volume drift lower that might suggest simple investor apathy. It's a more aggressive repricing based on evolving perceptions of risk. When we see a stock like Tesla stock react to delivery numbers or a behemoth like Nvidia stock move on AI developments, the cause and effect is often clear. For Wolfspeed, the drivers are more opaque and tied to long-term industrial projects. The market is reacting to whispers of potential delays at its new manufacturing facilities, concerns about wafer yields, and the macro-level anxiety over a potential slowdown in EV demand. These aren't just minor headwinds. They are fundamental questions about the company's ability to execute on its core expansion strategy. Institutional activity provides a fascinating counterpoint to this bleak picture. While some funds have been trimming their positions, filings reveal that other long-term investors, the kind who manage substantial portfolios through services like Fidelity Wealth Management or utilizing the advanced trading tools of interactive brokers, have been either holding firm or selectively adding to their stakes on major dips. Their thesis isn't based on the next quarter's earnings, but on the projected demand for high-performance silicon carbide in 2030 and beyond. They are betting that Wolfspeed's massive investment in its Mohawk Valley fab and the new Siler City materials plant will create a competitive moat that will be difficult for others to overcome. This divergence between retail sentiment and patient institutional capital is is at the heart of the current battle for Wolfspeed's stock price. For the average person engaging in online investing, perhaps setting up Schwab intelligent portfolios for long-term growth, this kind of volatility can be unsettling. It underscores the difference between investing in an established, profitable enterprise and financing a company that is still very much in a high-growth, high-spend construction phase. The macroeconomic environment has been particularly unkind. High interest rates make the cost of capital for Wolf's ambitious expansion projects significantly more expensive. Furthermore, any softness in the global automotive market, the company's primary target, has an immediate and direct impact on its projected revenue streams, making it harder for analysts to model future growth with any degree of confidence. To understand the stakes, it's essential to grasp what Wolfspeed actually does. The company isn't just another chip maker. It is a pioneer and a market leader in the production of silicon carbide, a compound semiconductor that possesses properties far superior to traditional silicon for high-power applications. Silicon is cheap and effective for logic chips, like CPUs and memory, but it's less efficient when it comes to handling high voltages and high temperatures. Silicon carbide, or SiC, can switch at higher frequencies, withstand greater heat, and operate at much higher voltages. In an electric vehicle, this means the inverter, the device that converts DC power from the battery to AC power for the motor, can be made smaller, lighter, and much more efficient. This translates directly to longer range and faster charging times, two of the most critical factors for consumer adoption of EVs. Wolfspeed's business model is built on being a vertically integrated powerhouse in this space. They produce the raw silicon carbide boules, slice them into wafers, and then fabricate power devices on those wafers. This control over the entire supply chain, from raw material to finished product, is a key part of their strategy. Their most ambitious projects are the John Palmer Manufacturing Center for Silicon Carbide in Siler City, North Carolina, which is set to be the world's largest SiC materials factory, and their 200mm wafer fab in Mohawk Valley, New York. These two facilities represent a multi-billion-dollar bet that the demand for SiC will grow exponentially. The company has secured long-term supply agreements with major automakers and industrial partners, which provide some revenue visibility. However, building and ramping up semiconductor fabs is notoriously difficult and capital-intensive. Any delay, any issue with process yields can have a cascading effect on financials. Historically, the company has shown its ability to lead in technology, but its stock has always been volatile, reflecting the market's ongoing debate about its valuation and path to profitability. For many years, it was a niche investment, but the proliferation of investing sites and online investment platforms have brought companies like Wolfspeed to a much broader audience. People using the Fidelity mobile app or the Robinhood stock trading platform can now get exposure to this highly specialized industry with a few taps, making it easier than ever for retail investors to participate in these high-risk, high-potential stories. Whether that access is ultimately beneficial depends entirely on their understanding of the underlying business dynamics and their tolerance for risk. Looking toward the future, the potential scenarios for Wolfspeed are incredibly divergent. The bull case, the reality that exceeds expectations, hinges on flawless execution. In this scenario, the Mohawk Valley and Siler City facilities ramp up on schedule and on budget. The company starts producing at scale, flooding the market with high-quality 200mm SiC wafers and devices which command premium pricing. As revenue scale, the heavy capital expenditures begin to pay off, leading to significant operating leverage and, finally, sustainable profitability. New design wins from major automotive and industrial players would further solidify its market leadership position. Government incentives, like the CHIPS Act, could provide financial tailwinds, de-risking some of the capital investment. If EV adoption re-accelerates and demand for SiC and solar and energy storage applications continue to grow, Wolfspeed could find itself in an enviable position as the go-to supplier for the core components of the green economy. This is the outcome that patient investors, perhaps those holding the stock in Fidelity mutual funds or various Fidelity ETFs, are counting on. Conversely, the bear case, where reality falls short of expectations, is just as plausible and is what the current stock price seems to be pricing in. The primary risk is operational. Any significant delays or yield issues at the new fabs could be catastrophic, leading to further cash burn and potentially requiring the company to raise more capital at depressed valuations, diluting existing shareholders. The competitive threat is also very real. Competitors in both the US and abroad, especially in China, are investing heavily in their own SiC capacity. If they can ramp up faster or produce at a lower cost, it could lead to intense price competition, eroding Wolfspeed's potential profit margins. A prolonged slowdown in the EV market would also be a major blow, as it remains the company's most important growth driver. Finally, there's the financial risk. The company is burning through a tremendous amount of cash. If its path to positive free cash flow is extended further out, investor sentiment could sour completely, turning the stock into a show-me story with a very skeptical audience. Many investors using services that